Welcome back to the channel. My name is Brad, and today I'm going to go through what is in my wallet, which is really what is in my portfolio. If that's what you're interested in, stick around. So I've been retired now, officially a year. I actually talked to my old boss the other day, and I started the YouTube channel in August, so 11 months. For YouTube, a year since I actually quit my last job. No job. So here we go. We're going to go real quick through what I have. I have 5 pillars. I still use covered calls, business development companies, preferred stocks, alternative assets, which is Bitcoin, gold, master limited partnership, and REITs. And we'll get to those. And I have collateralized loan obligations. Notice I don't have any bonds. I've tried bonds. Bonds I just don't like. My CLOs, consider them to be more like the bond fixed income kind of situation. Same thing with the preferred stocks, but we'll get to those. Why do I do this? That is the next question, because if you have a great start, no problem. You are living well. As we've seen with the market turbulence, it has been all over the board, and we're just going to go ahead and say, let's go ahead and have a little bit of diversity with some fixed income so you just don't go broke. That is what I'm trying to do with the 5 pillars. Just remember, not every year is an up year. Not every year is a down year. And which way that goes, nobody knows. That is a good rhyme. Man, I'm thinking of it today. We can see what the percentages are. And we're probably going to be in that 10 to 20% again this year. It has been 13% here for the last few years on an average. Just keep that in mind. With an M2 going up, which I talk about every now and then, I expect that we still see money go into the market and things go up over time. And remember, other countries globally have already lowered rates. They invest in our stock market. Just keep that in mind when you're thinking about this. They're coming out of a recession. We might be going into a contraction, maybe just coming out of the contraction, but others are ahead of us. So you might not see the same cycle for cash flow because they're already pumping their markets. Now, let's talk about my growth. And I don't talk about my growth, and I don't share exactly how much this growth side actually is worth. Just to say, I did well when I worked. But hey, I have CSHI, more of a conservative play, SPY, QQQ, Berkshire Hathaway, and IBIT. I'm interested in Granny, but right now, I am not going to put any more money into my growth side. And I still have some cash sitting on the side just in case the market takes a total dump. That way I don't go get a JOB. But I am interested in Granny. And remember, one thing that I should point out that, hey, we may be looking over the next few years that technology becomes a bigger and bigger part of our economy. And if you're not paying attention to this, you might be just investing in SPY, and next thing you know, you're not outpacing the market with inflation. And we just need to stay in front of inflation, especially in retirement. So the first one I'm going to cover is business development companies. Business development companies, I have PBDC and BizD is my main two. I take everything from their distributions. I do not reinvest anything back into PBDC or BizD. Now, before anybody starts typing and says, their expense ratio is too high, I'm going to leave that in the pinned comment and in the description so you don't bother me about why their expense ratio is so high. Nothing wrong with it. Their management fee is actually low for what they do. And by the way, it's above my cost basis. So there you have it. We took a dip, now it's back above. But I also have ARCC, BXSL, HTGC, Maine, Blue Owl Capital, which is OBDC, and Trinity, which is TRIN. Those are also in there. Very, very small holdings. They're in green because they're on drip. One day, I might be building these out a little bit faster than just being on drip. But we're going to expose that at the end of the video so you can see what I'm doing. And maybe I start building out these a little bit faster than what they are today. Right now, they're on drip. I have preferred stocks, and all the members are sitting there looking at my preferred stocks. ECCD just happens to be up 5% since I bought it. So, wow, it's actually like almost beating the stock market. Just pointing that out. But that's not why I bought it. It is a fixed income product. I get paid every month. I keep that money. I do not reinvest it. PFFA. I keep it every single penny. I don't reinvest it. I take it. I was going to reinvest it. This is sometimes why I have a little bit of cash sitting in my account, and I say, hey, I'm going to go buy a couple shares of this, a couple shares of that to build things out like the business development companies, because I'm not reinvesting in EIIA or any of these preferred stocks. But it does really help having some fixed income that I don't have to worry about with the market going up and down. Not a huge amount, but I am in retirement, not trying to grow my accounts. Well, or am I? Just a little bit, just to stay in front of inflation. Let's get into my alternatives. I have BTCI, I have BAGY, I have IYRI, which is my REIT, and I started the gold fund of IAUI. Now, I'll just go ahead and share this out to everybody. So my SPY and my QQQI, which is in my cover calls, and my GIAX, and some of those are above my cost basis. So what do? Well, I'm going to be a little bit smart about it and drip it back into IAUI instead of buying more cover call funds. That's what I'm doing right now. I want to build out the gold fund very slowly. Hey, there's some risk to reward, but I also have BAGY. That's a little more risky because it rates on almost 100% of the portfolio, but that's okay. It's actually beating BTCI in total returns, but that is okay. And I'm not reinvesting back in the BAGY. That's why sometimes I am a little bit cash rich and I invest back into things that I think might be at a discount. Now, AMLP is on drip. Been really testing that one out, and I'm pretty happy with it so far. MLPR, well, that one's up for sale. That's why it's in blue. I already have limit orders on that one. I'm taking 100% of the distributions, and when it hits that limit order, it will just get sold. We'll just call it that way. Now, I got into MLPD and MLPX. These both combined do a pretty good job. Now, holding one over the other, just remember, one of them is writing cover calls on it, one is not writing cover calls, so you're seeing 100% upside without getting capped and paying the distributions, but the other one's getting capped. When you put them both together, they actually do a pretty good job and get me about that 8% as a average for the distributions. And that's what I like about it. And AMLP is also staying. Now, somebody's going to say, Brad, in the past, you said all your money is in IRAs and you have master limited partnerships. And I just roll my eyes every time somebody says that, because they did zero research when they said it, because these are all friendly for IRAs and Roth IRAs. So some master limited partnerships are not friendly to IRAs, but these are. That's because of how they were formed and their taxation of how they're formed. They take care of all those K1s before it gets to me, so I don't have to worry about it in my IRAs. Please, before you go typing comments, go to the websites and do your research so you can find out that, hey, maybe I can hold a master limited partnership inside of an IRA before you make some dumb comment. Yeah, we're just going to call it dumb comment. Anyway, we're just going to move on to the rest of it. CLOs. Now, they took a hit up and down. EIC took a hit, but EIC is trading below their net value. That usually means it's going to go back to the mean, which will get above my cost basis again. So I'm not too awful worried about it. FSCO has actually been one of the best performing out of all of them. Just towed out. I mean, beats the cover calls, beats the SPY. I mean, it's just been killing it. Anyway, I drip that one. I drip EIC, and then I take off what I need to live on. Now, JBB, B, and clause and JAAA, they're just in there paying out distributions, and I take 100% of it. And that's why sometimes I end up being a little cash heavy again, and I look at things to buy. Now, I'm also interested in CLOB, and maybe I add that to this portfolio over time. So those CLOs are double A's to double B's. So something I'm interested in. I think the last time I looked at it, it's paying about 7%. Not quite 8%, but somebody's going to say, hey, you don't do this one and don't do that one. That's because maybe I don't want a whole lot of like other things like closed-end funds. So if you're not going to sit there and read annual reports on a closed-end fund on a quarterly basis, you might have problems. Right now, EIC is a closed-end fund, and it's something I have to worry about is those quarterly reports and actually get out and read them to see what's going on. Little more complicated than a ETF. And you might ask, why is it more complicated? Because an ETF reports their NAV that everybody likes to talk about every single day, where closed-end fund only reports their NAV once a quarter. So good luck on that one. That's why I stick more to the ETFs than closed-end funds. Now, let's get into cover calls. Oh my. Brad's list has changed. So Brad has SPY-I, QQQI, and they are both above my cost basis. Just in case you want to know, IWMI is below, but coming up very quickly. GIAX is below my cost basis, but also on a nice rise. Now I have cover calls named Brad, and Brad is going to share what is actually inside those cover calls. I have T-SPY. T-SPY is getting up there very nicely also. And then GPIX and GPIQ. Now I have a rule, or try to have a rule of if it's within 3.5% of my cost basis, that I don't reinvest. Well, right now, IWMI is a little bit more than 3.5%. GIAX is more than 3.5%, but T-SPY recently, because of the market move, is within 3.5%. So guess what? I won't be reinvesting back into T-SPY, but I'm going to use those funds and start building out the gold fund. And if it drops below 3.5% again, hey, I can reinvest back into T-SPY. Now, I'm also interested in QDevo, and a QDevo video is going to come out sooner or later. And I am going to share what my thoughts are on QDevo. I've been tracking their calls, almost 2 weeks now, and I like what I see. They're only writing on a small percentage, but it may or may not be for you, especially the way that they just wrote their last index call. You might be a little surprised at what they actually did. Now, there's a whole conversation about yield max, and yield max beats QQQI and SPY-I, and I just sit there and sometimes I wonder to myself, maybe I should have bought YMAX, but no, I'm going to go ahead and sit here and tell you YMAX has funds I just don't like. I have some of the stocks I don't like and a YMAX at a larger percentage than I want them. But let's go ahead and talk about this. So I feel that these companies may do good over the next 5 years. You can look at the list. It's not the first time I've shared this list, but I am looking at having a little more exposure to individual ETFs. Now, why do I want to do that? Because individual stocks have a higher implied volatility. Let's go ahead and say the volatility of SPY is somewhere between 12 and 16. Right? And some of these have volatilities 30, 40, 50, 60, 70, 100. I mean, come on, the volatility's very high. So they're going to pay larger distributions. And that is something that's very interesting. Now, Berkshire Hathaway doesn't have a very high IV, but that's okay. I still feel that these stocks over time may be something that you want to have. But we're going to get into what I'm doing in Brad's covered calls. So let's get into what's in Brad's crypto holding spectacular. I don't know what I'm going to call it, but hey, let's call it something. I invested $81,000 in $3.30. What I did was I bought some of the KURV, I bought some of the yield max, I bought some of the REX. I'm not reinvesting back into any of those. I'm taking 10% every single month instead of my 8%. And I really should clarify that. That is 8% annually, 10% annually, not 8% a month. But mathematically, it is 8% is 0.0067. And hey, if you do 10%, it's really close to 0.0085. Just to give you the mathematical behind it. I just take that little percentage out every single month, try to draw it out. What I've been doing, I have been investing in GPTY. I've been investing back into BITY. I've been investing back into BTCI. And I bought some CSHI, CSHI, as where to hold some cash. Now, going forward, I'm adding QDevo into the mix. And once this gets up to a decent sized portfolio, I might take these and track these in my regular portfolio. But I'm not reinvesting back into the single funds whatsoever. My total return in the last month has been 5.17%. And if I take out what I withdrew, which was $688.50, my total return was 4.32%. Now, I'm not saying this is for everybody. It's a little more work, but putting these in, having different funds that I picked on my thought of which funds I really want to have, I'm actually doing pretty well. And maybe I can get GPTY and QDevo to somewhere around, drum roll, about $30,000. Once they're about $30,000, I will take them out of here and maybe I'll invest in something else that I want to build out over time. Maybe business development companies. Wink, wink. But here you have it. Now, CSHI, every couple months, I'll buy another single stock because I had that whole list of single ETFs that I really was looking at. And let's talk about which ones I might be a little more interested in, not as replacements, but as complementary to what I already have. Because look, I have MS2, that's MSII, and I have Misty. I don't think that they are competitors. I think they're complementary to each other. A little bit different when you think about having complementary funds because one may have a little more growth. One may have a little more NAV erosion, but one may have greater total returns. There you have it. Just saying, don't get too tied up because remember, total returns is where you really should be looking. Let's go ahead and talk about what I'm interested in. I'm actually interested in the weekly pairs from Roundhill. Watching them, not buying. I think they're interesting. They're not writing cover calls, but they're paying you out on IV and how the fund has changed in price. That is interesting. So maybe adding something like this, so adding these as a complementary to KURV, Yield Max, REC shares may be something you might want to consider. Again, not competitors, but complementary to the others. So hopefully you found this interesting and fascinating. I'm looking at these new Roundhill funds as a complementary to my singles, not replacements. I'm looking at rec shares and their new funds for growth and income with a little bit of leverage as something very interesting, as complementary to maybe some of Yield Max, and pairing them up together. And I'm not reinvesting back into these funds. I'm using distributions for their funds and building out a little bit of QDevo and building out GPTY over time and getting up to about $30,000. Then I'll decide, what am I going to build next? Maybe business development companies. Maybe I put that CLO in there and build that out with everything, but not reinvest back into the funds. Prices go up, prices go down, don't care. I want all those revenues to come in, pay me, put the money on the side, and build out the other funds. So until next time, God bless.